Hello class, welcome back to Every Day is a Business School Day, and today we are talking about the rather meaty subject of mortgages. Nicky is back, of course. Hello.
Hello.
And we have a guest. Would you like to introduce yourself?
Hi, my name's Vicky Probert and I'm from Honey Financial Solutions. I am a mortgage and protection insurance advisor. Been going since 2017. The Honey Financial business I've had from 2020. So yeah, quite a few years now.
So, for clarity, you are not a mortgage broker.
Well, it depends, because somebody will call you a mortgage broker, somebody will call you a mortgage advisor. So it's pretty much a similar thing.
So you are just a mortgage expert.
Yes,
That's
that
what
is a
we'll go
better,
with. That sounds better, doesn't it?
Better,
Yeah.
better.
Specialise in mortgages.
Exactly.
I find this interesting because I just coming up to 2 years ago, bought my first house, so went through all this, and now I've just gone through remortgaging. So I used an advisor / broker first time around, and then I remortgaged by myself, big boy pants and all that. Quite different experiences. So that may come up in the course of this conversation. I do think the mortgage thing's really interesting because it's probably the most important thing, maybe outside of having children, the most important thing that anyone ever does, because you are signing away a huge amount of your life, and if you get that wrong, you have problems. Like, that is a really bad thing to get wrong. So I'm glad that we're getting on to talking about this. I want to start with a bit of a disclaimer, because we are recording this a week before the autumn budget.
Yes.
Which may change the landscape and move the goalposts and all matter of other cliches a fair bit. We've got no idea. As we record this, we have no idea what's around the corner, because it actually, like, a couple of weeks ago, there seemed to be a bit more certainty about what was going to happen in the budget, and then they went, no, we're not going to do that anymore. So it's all a bit like, who knows? So anything to do with, like, I will no doubt ask you, when is the right time for someone to get a mortgage? We just don't know, do we? Because what things, if we were recording this in 2 weeks' time, it may be an entirely different feel to the conversation. So that's just starting with a little bit of a disclaimer about the fact that is around the corner. So this is pre-budget as we talk now. Talk us through, like, the mortgage landscape as you see it at the moment, because it's been, the last 5 years has been crazy, hasn't it?
It has. It has been up and down and around and back again.
Everywhere.
Yeah. So who'd have thought within COVID that people would have actually been moving with the uncertainty? I've never seen locally so many for sale signs, people moving.
I moved in COVID.
Did you?
I do not recommend that.
I'll hope you will not have COVID again for a while.
Yeah, but honestly, if we do, it was fairly horrific. But I did it anyway.
People bought houses without seeing them, didn't they?
Not
It blows my mind that people did, like,
doing,
a virtual
videos. Yeah, I found that really
buy a
weird.
house, and then the day they moved in would be the first time they've actually seen their house, which is just mind-blowing.
It is. I didn't personally have any clients like that, but I have heard that people were doing that, and I just think, how do you get a feel for the house? How would you actually know that it suits you? Because I'll talk to clients and they'll be, I've walked into the house and this feels like the right house. There might not be any reason behind why that feels like the right house. So how would you know if you've only seen it on video? I have no idea.
Yeah,
I was kind of lucky in that we actually bought the house in the summery bit in between the two lockdowns. So we did get to go to the house and we did actually get to spend a lot of time in it. But then we actually moved in the horrible winter lockdown that came afterwards. And that was kind of hilarious because basically it was like us and the removal people all having to try and avoid each other in the house, which was quite funny. But and it was cold. And it was awful. And no one was in, and like the land registry wasn't there. So yeah, it was a very difficult situation actually.
I definitely think houses have a vibe as well, and you've got to feel it, haven't you? Like, it can't just be what it looks like. But yeah, so we had all that, and then since then we had, I don't know if we want to mention the L word, but we had the Liz Truss budget.
Oh, I was thinking, did you mean Liz?
All the stuff that happened off the back of that, and as we sit here now, it outside looking in probably feels a bit more stable than it has been for quite a long time.
Yeah. with the budget of Liz Truss, things just were awful for advisors, for lenders, for clients. I had a client that was on holiday, and literally I had I had to go for three different mortgages, and they kept getting pulled every single time. And it's like, right, I'm really sorry, we're going to have to start again, because the lenders, the uncertainty, they were just like, right, we're going to have to pull that mortgage deal and we're going to have to start again, because the markets had just gone mad. Everybody just didn't know what was happening, and it really made the job really difficult. But now, like you say, even though we've got a budget coming up, and previously it's all been a bit, we don't know what's happening, there is a bit of that. People are like holding off at the moment for moving or looking at other properties. Remortgaging is fine, but it's nowhere near the uncertainty that people had around that time.
I think it's safe to say, though, that the housing market is always a bit of a mess. I mean, you get like little bits where things improve, but I suspect it's never a really stable environment, is it?
No, it has so many influences outside of it that are out of our control. You know, coming out of the EU, the war, like what's happening in America, COVID, it all has an impact. So, there is always something, because I'll have people all say, what do you think is going to happen to the interest rates? And it's like, I don't know. Who'd have thought that we'd have had COVID? Who'd have thought that there'd been a war? So you just never know. You can think, but you're trying to see into the future, and I haven't got a crystal ball. So
no.
Yeah.
Did the all the stuff around the Liz Truss budget, was that just a temporary thing, or has that kind of changed things like permanently now? Because I hear a lot about whatever happens in the budget, current mortgage rates are kind of unlikely to change that much, because lenders are now really working in what they think is going to happen in the future into their current rates. So it's relatively stable, whereas before they were really, really low, weren't they? And it was probably inevitable that something was going to break that back.
Yeah, definitely. I mean, the rates had been the lowest for 10 years. They were really low. And then Liz Truss's announcement brought forward and speeded up what was inevitable, what was going to happen anyway, that interest rates were going to rise just because of what was happening in the economy and everything.
But they were unnaturally low for a very long time, weren't they? But I think that actually, because they've been so low and for so long, a lot of people who would come into the mortgage environment didn't understand that wasn't normal. And so I think a lot of people found themselves in a very difficult financial situation because they hadn't thought that it could ever be higher than that. Whereas for some of us, when we bought our first houses, our interest rates were really high.
Yeah.
And, that was a bit of a jolly holiday for a while, but we knew that wasn't going to last. But for a lot of people, I guess, they didn't know any different because it had been like that for so long.
Yeah.
And then all of a sudden they got a mortgage rate that is really crippling. And so I suppose that's something you've got to, as an advisor, help people to not necessarily see into the future, but effectively see into the future, but they're not putting themselves in a situation whereby a small change in interest rate is going to make the difference between whether they can go on holiday ever again or not.
Yeah. As part of, I suppose, the information that you give to clients, you have to give them a mortgage illustration that says what the repayments will be, but it also has in there examples if the interest rate should change and if it goes to this, these are what your monthly payments would be. Like you say, people, if, say, for example, a first-time buyer, they could have remortgaged 5 times if they're on 2-year deals and never known any different on the interest rates.
Yeah.
And then all of a sudden, there's these big jumps. Things are a lot more settled now. They did rise. I knew the higher interest rates from when I didn't buy my first house, I built it, so that's a different thing. I went straight in there. But yeah, they were higher at that point. But now people are seeing a bit more normality. So yeah, there is talk that potentially interest rates will come down, but they're not going to come down to where they were. It's just not realistic. If they do, I'd be really shocked. It'd be great if they did. but they are so much more stable now.
I think we should probably pull this back round to Steve, our business owner that we quite often talk about in this podcast. So Steve's a small business, and I think that people who run small businesses, there's a kind of misunderstanding, I suppose. They think that, whenever we talk a lot about mortgages, we talk about, how much you can lend based on your salary and your pay slips and that sort of stuff. And if you're a small business, you quite often don't have that.
Yeah.
You probably don't even pay yourself a proper salary, or you certainly don't have any pay slips. So if you're a small business, how, can you get a mortgage? How can you get a mortgage? Is it the same as when you've got a permanent normal job? Because it feels like quite a scary kind of process when you're a small business and you're just starting out.
Outside looking in here, and I say outside looking in, I mean, I went through this a couple of years ago, but does feel like most of the information out there is very much centered around, like, you are employed in a stable job and you've been there for 2 years and you've passed your probation, and this is then how it all works. Whereas actually, particularly in the modern, kind of work environment, a lot of people who are self-employed, people who are freelancers, people who are business owners, and all manner of different combinations, and there's maybe not quite as much info for them.
Yeah. It is quite complicated when you're looking at the different forms of self-employment, like you say. So there's different rules for different things. If you're looking at somebody who's a sole trader, they'll look at their income and how the lenders will look at their income. Basically, if an accountant does it, or if you do it yourself, there are some forms that will be on the HMRC website once you've done that. So it's a tax year calculation and a tax year overview. These are what the lenders want to see. On the calculation, that basically says how much you would have earned over the last year. And that is what the lenders will look at. So yes, it is easy to have pay slips because you can just hand them over and they're probably the same each month. But then when you're looking at self-employed, there are some lenders that will look at 1 year's income, depending on... You probably pay more on interest rates for that because the lender's taking more of a risk because they haven't seen the consistency of the income. I would say majority of lenders will look at the average of your last 2 years, but they average it. So say if the first year, which... as business owners tend to be lower. The second year has increased, but a lot of the lenders, because they want to mitigate that risk, they'll average it out. So that's how they'll look at it. So that's from a sole trader's point of view. If you then look at a limited company where there may be one shareholder, two shareholders in there, you can look at it slightly different. So you can look at the personal income, or the same on the tax calculations. But if you're a limited company, the lenders can also look at the limited company and see what their earnings are and base it on that as well. And they can be very different. Somebody might be paying themselves, say, 13 grand a year and then get dividends. So personally, they might not look as though actually they're earning that much money. But then they may have their own business. And for the last 2 years, they may have consistently had a net profit of 80,000 each year. That has a massive difference as to basing it on 13,000 and maybe a couple of grand on dividends. But then now you're looking at a company and you're saying actually they're earning 80,000 plus the salary. It makes it's a big difference there.
So what would you say on, what you're saying is that basically as a small business, you've got to probably have got a couple of years under your belt realistically before you can even contemplate having a mortgage.
Yeah, I would say so. And I would say make sure that you make your accountant aware of what your plans are, that you're looking to get a mortgage, because they can then plan out how... You're never going to avoid tax and you're always going to declare it how it needs to be. But sometimes there's things as to how you can look at your income that the accountants can set up in a realistic way for the lenders. and then talking to a mortgage advisor as well, or even having a look at your own affordability online. The only problem I foresee, because I've got too much information up in my brain to think, how do people do these themselves? But there's a number of lenders out there, you can go on their websites and you can do the affordability calculations yourself, and it'll give you an idea. But you don't know what the criteria of those lenders are. So you might put those figures in, but you might not realise they're not going to take those figures. They're going to look at it in a different way.
And there's a lot of like hoops and stuff you have to jump through, isn't there?
Yeah.
That I didn't, having done it both ways now.
Right.
And when I remortgaged, I actually remortgaged with my existing bank, who know everything about me. They probably know more about me than my own family, because they know absolutely everything that I've spent for the last 25, 30 years or something. So I thought, this will be more straightforward. Just lots of talking and lots of things to sign and lots of documents and just all manner of complicated things. So when I was getting ready to do this, as someone who is a sole trader, I started being quite careful, shall we say, in what I spent. So I realised that as a sole trader, it's based on my profits, and therefore, if certain purchases and things that I think, do you know what, actually I maybe don't need that right now. So, maximising my profits to try and maximise the amount that I can borrow. So, over the course of probably about 18 months, 2 years, I was really careful to kind of prepare. So, I started out my mortgage application, if you like, about 2 years before it ever really came around, which was great. Now, the downside of that then, when after that, all the stuff that I'm like, right, I've got the mortgage sorted, I've got the house, now I need to spend loads and buy all this stuff that I've been putting off. And then you've got to buy loads more stuff for your house. So I'm like, I've got to pay myself a little bit more. And then when it came around to remortgaging, they were like, your profits seem to have dropped quite a bit.
Yeah.
And I'm like, oh, yes, well, let me explain what happened there.
Yeah.
And they were cool with it. And as I say, it's my existing bank. And so I got the benefit of the doubt on that. But then I thought I'd been really clever by doing it like that. And then suddenly something else comes along and it kind of bites you the other way then. What's your advice to people in terms of how can you plan ahead for this? How much should you prepare in advance? Are there things that are really worth doing, or actually the things that people like me might think, I'm being quite clever by doing this, but actually I end up shooting myself in the foot?
You were being clever in the way that you prepared for it, because there are a few self-employed people that'll just, I need a mortgage, and you're like, right, okay, we've not talked about that. And it's, planning ahead is just essential, just so you can get things lined up so that actually you're gonna be able to get the best mortgage deals. So for things like purchases, there are so say for example, I had a client that had built something, so his profits went down because he built something. Now I could talk to the lender and they were like, oh, actually, right, we'll take that into consideration. And as long as the accountant will agree to that, so it's talking to the accountant as well. Would they say to a lender, yeah, the profits have dropped for this reason? It's nothing to do with like income's dropped or anything like that. It's just purchases or things that have been happening in the background. So yeah, again, like say, talking to an accountant, I understand where like you had a lot of purchases afterwards and everything. And what I would also say is going to your own bank is not always the best. They may end up being the best deal. You think that, yes, they'll look at your account and they think you're a loyal customer. It's a bit of a myth. It's they don't necessarily deal like that. It's not like the good old days. I remember my dad going to his bank account, his bank manager, and he's like, I've seen this house, and because he used to do a few properties up. And they just used to give him a loan because they knew him.
Yeah. Those days, they're long gone.
Yeah, they're long gone.
Yeah, the computer now.
Yeah,
computer says no.
Yeah, computer says no. So yeah, it's not always the best thing to go to your bank. They may end up being the best deal, but it's not for the reasons that you've banked with them. They know what's happening and everything. But I would say it just depends. If you can look at your affordability, as in, right, what is the ideal property I would like to own? What kind of deposit am I going to have for that? And then it's like working it backwards. So then you can think, right, okay, so I know I need to buy this. I can actually still buy this year because I've looked at my affordability and it'll still work out okay. Or do you have to delay it? Again, like you say, it can have repercussions on your remortgaging. It's a balancing act.
It's just mega complicated, isn't it? And it's such a minefield. And I guess my next question, and I mean, I know what your answer will be to this, but to kind of dig a little bit deeper into, you know, is it advisable to use a broker or an advisor over kind of fumbling through and doing it by yourself? What do you get by doing it with someone?
So if you're doing a mortgage yourself, then this is where it blows my mind, I think. How do you know which is the best lender to go to? Do they suit your circumstances? Is it going to be the right thing for you? Now, you still might come to the same conclusion as an advisor, but what an advisor will have done is looked at things like your credit file, because that's one of the most important things to look at. They'll have seen what was happening on there. They'll have looked at your income. They'll have seen, is there any questions that a lender's going to ask about your income, such as, right, well, why has your profit dropped this year? But an advisor would have already looked at that. They'll talk to you about the differences in your deposit, what difference that can actually make if you put a higher deposit in. Mm-hmm. They'll have looked at your, say, like your proof of ID as well, or your proof of address, because sometimes there might be issues on there that you don't realise, but an advisor will pick that up, because our jobs as an advisor is to look at, right, this is the jigsaw puzzle. I just say it's like a jigsaw puzzle. Each of these pieces you have to put together, and then you put it all together and you match that with a lender. That lender might not be the cheapest one, but actually it'll suit your circumstances. And actually, even though it might not be the cheapest, you might not be able to go to those other lenders anyway. So if you do it yourself, it may sail through and it may actually be fine, but you might get to a point where you should never have applied to that lender in the first place because of your circumstances. They're just not going to fit. When you go, say if you go into a bank directly themselves on the high street, not that there's that many there these days, they are not advising you. The staff that are in the branch themselves, they can't advise you because all they can tell you about is their mortgages. They can't say, oh, this is how ours compares to the bank down the road and everything. So we'll look at all that as well.
Yeah, I suppose it's breadth of knowledge. And I suppose, you know, arguably, it's like any specialist, isn't it? It's like, well, anyone can pick a microphone up and do a podcast, but actually, will they understand the strategy behind it? Will they understand, all the different implications of that podcast? No, because they don't have the experience, do they? And they don't have the breadth of knowledge, and they haven't made the mistakes and learned from them and all that kind of stuff. So I suppose what it comes down to is, breadth of knowledge. It's that wider view of the industry that you wouldn't necessarily have. But I suppose, it depends on what you want to do. And I know quite a lot of people who've done their remortgage just by staying with their current lender and renegotiating their rate, and they've been really happy doing that, and that can be done fairly easily online. But and there's nothing wrong with that. But equally, my mortgage advisor will literally, if anything's about to change, he'll literally phone me up and say, right, we're moving now. Needs to do, forms are done, tell me when you sign that, we're moving now, because if I don't move you right now, you're not going to get the best rate. So for me, that proactivity is massive. Because it makes a massive difference to us, when we're going, well, we know we've got to remortgage at some point in the next couple, few months, and he will, there was a big change in the rates, and he literally was on the phone going, it's all ready, we need to move now, otherwise it's going to have massive implications, and he'd done it all for me, so that proactivity, it's really cool, actually, because I wouldn't even have been thinking about it.
It's quite slow when you do it by yourself as well. So I should add a little bit of context to this, because this is not me being incredibly renegade or anything like that, but I knew that I didn't want to stay with my current provider because they don't even have like an online portal or anything like that. I've got to ring them if I want to find out how much I still owe on my mortgage and stuff. Quite old-fashioned building society, and that's just not how I operate. So I'd already decided I would probably be looking to move anyway. Plus the rates weren't particularly great, and did a little bit of kind of shopping around and looking around, comparing rates, and so that my existing bank were equal to the best rates that I could see. But then I did sit down with a mortgage advisor, because the growth community group that I'm in, we've got a mortgage advisor there. So I did sit down with him and just sense check it all.
Yeah.
And he said, yeah, you're not going to get anything better than that. And yeah, you're doing everything right. And I needed that kind of, just that little nod from someone just to go, yeah, sense check, you're getting this right. Otherwise, I don't know if I'd have actually had the balls to actually do all that stuff by myself. But then, you know, my bank don't work with brokers, so I had to do it directly with them anyway. That's kind of part of how they sort of work. But yeah, it is quite scary, and you do have a lot of stuff, and there's all manner of, like, even now I get emails every couple of days saying we've uploaded a new document to your portal, please check it, and it's kind of quite overwhelming. And a lot of ways I wish I didn't get any of this first time around. Someone else just shouldered all this stuff. I kind of feel like I wish I'd have done that. I can imagine a lot of people who, wherever they are on their kind of their business journey, knowing that this thing is kind of hanging over their head in terms of, like, I want to buy a house, I want to invest, I need a mortgage, but it doesn't feel like now is the right time. I'm going to wait. Is there a right time?
No. I would say there isn't a right time. A lot of people were waiting for Brexit. And I think that's why a lot of people ended up moving in COVID times, because they've been waiting for Brexit to see what would happen there. Mm-hmm. There's, like you said earlier, there's always going to be something that comes up that you just don't know what's around the corner. I think looking at things as a big picture sometimes doesn't help. It's like, if you look at what you can control in your own sphere, then it's just easier to look at it like that, because if you're second guessing what's happening, you're probably going to wait, and sometimes it might pay off and sometimes it might not. But I would say there's never really a right time.
I think if your intention is to buy a house, then, and that is definitely something you want to do, then cracking on with it as soon as possible is probably still the better option, because you might not get the best rate as a first-time buyer. You've obviously got to save up for a deposit, and you have got to get yourself mortgage ready. So there's a lot of work to do to get to that point. But at least once you're on that ladder, then it's only going to get a little bit easier after that, because you'll have more accounts and you will have already proved yourself with a mortgage lender, and the whole thing improves once you've done it. The first step on that ladder is really bloody hard work, isn't it?
It is, because you've got to understand the whole process, and it is a bit mind-blowing for people. And even more so with self-employed people, because it is a bit more, there's more paperwork required. There's more of an understanding, whereas, like we said earlier, you're employed, you've just got payslips. As long as you're a permanent employee and you're out of probation, it is easier.
Which is really bizarre, isn't it? I always found that really bizarre, because you could get made redundant at any moment. Whereas if you're a business owner, you have a bit more actual control over what you're actually trying to do, haven't you? I do find it really strange that. But, it is just the way of the world, isn't it?
Yeah, it's the way the system.
But it shouldn't. But, but I think the really important point here is that if you are a small business owner, you shouldn't be thinking that mortgages are not attainable to you, but it is just about being organised and planning, your approach to getting to that point. Like you do your 90-day plan for your business, you almost need like a 2-year plan for your mortgage, don't you? What you're going to do at what point. And
go and talk to someone, find someone that you can really engage with, that you get on with, that you feel you can trust, that's going to hold your hand and kind of get you through it. Yeah,
it's getting your team around you, isn't it? Having a mortgage specialist, having your accountant, because those two people are going to be the most instrumental in the whole process, aren't
and your
they?
solicitor. Getting
Well,
a good
yeah, you
conveyancer.
must put in the solicitor as well. But, you know, to get to that point, you know, you financially, if you've got a good mortgage advisor and a good accountant working with you,
Yeah.
then actually you're going to have a much smoother ride at the end, aren't you, than if you just kind of rock up and go, I'm going to buy a house.
Yeah, definitely. I would say preparation's key, and I've always said you're better off talking to somebody a year, 2 years, 3 years, 5 years before. I've had clients that I've been speaking to for 5 years because I've spoken to them, they've gone away, they know what deposit they want to save. In the meantime, property prices might have gone up, so it might take a bit longer. But preparation is definitely key. The big thing for me, as well as the income, is the credit file. What's on your credit file? So I used to, when I first became a mortgage advisor, I used to say, have you ever missed any payments? Is there anything that's happened that might impact the mortgage that you can go for? And if they said no, I'd be like, that's fine. But then it bit me on the bum.
Yeah.
Because somebody might not realise, actually, unless they check the credit file, they may never have missed a payment, but it doesn't mean to say what's on the credit file is actually accurate. Companies can misreport information. So I had one where they'd said that she'd not paid the gas and electric for 4 months. She had, but they'd misreported it. So it took a couple of months to get that amended because she's then got to go back to them. She had to, fight her side of things. And then they take time to update the credit files.
Right.
So credit files are probably only updated once a month by each credit reference agency. So I suppose to put into context, what is a credit file? So a credit file is basically where if you've got credit such as a credit card, even like Klarna or PayPal, and that's another issue in itself, it will all be reported onto a file. And this file is where the lenders will go and they'll look at that file and they'll look at it and think, how good do I think they'll be in making payments on the mortgage. So checking the credit file to see if there's anything on there that's not factually correct, you need to make sure that it's in as good a position as it can be. There might be actually things on there that you might have a counter court judgment, a CCJ, you might have missed payments. A mortgage advisor will deal with that, but when it's incorrect information, you don't want to get penalised for that. So dealing with that a few months ahead and everything, at least, and keeping an eye on it as well, and not just checking one credit reference agency. There's 3 out there. There's Experian, Equifax and TransUnion.
Yeah.
Check all of them because they can all hold the same information or different information. So, yeah, and that's not just for self-employed people.
Yep.
Yeah.
Yeah.
There's plenty of information out there that kind of talks about the difference in types of mortgages, and obviously there's kind of like a couple of different sort of variable rate mortgages, and then you get fixed mortgages. 2 years, 3 years, 5 years seem to be the main ones that are kind of knocking around at the
7
moment.
7 years, 10 years, lifetime now as well.
Really?
So, yeah.
Crazy. As someone who is a business owner, whatever that looks like, is that same information relevant to them, or does that equation look a little bit different in terms of what they should be weighing up, in terms of what the right kind of mortgage is for someone in that situation?
So generally, the mortgages are the same. So whether you're employed or self-employed, generally the rates, there's only 1 or 2 that I know that might be slightly different, but generally everything's the same on there. Fixed rates, it depends on what you want to do as your circumstances. So I would say if somebody's planning to stay in the same property for a number of years, you probably want to look at a mortgage that's maybe around a 5 year, unless you've got a plan where you think, actually, I'm going to move in 2 years, I'm going to move in 3 years. You probably want to look at mortgages that are around that. When it comes to different types of mortgages, so your fixed rates, your variable rates, so the benefit of the fixed rates, you'll know what you're going to pay on a monthly basis. So it really helps you with the budgeting. There's different kinds of variable rates. There's no point in going into those now because you'd really need to know the benefits of those on your individual circumstances. But the variable rates, the good things about those are they might tend to be a bit cheaper, but if you do want to move, you might not have penalties to pay if you want to move in that time. Or if you're not really sure what's happening. So I have a client who actually they're looking to knock down the house and rebuild it. Literally, it's gone through this week. But for a while, they weren't really sure how long that was going to take. So they still needed the mortgage on their own property in the meantime until we went to this specialist lender who would take into consideration that there wasn't a house there. But the benefit of that was they could change the mortgage at any point and there was no penalties to it. So that's where it's always, as an advisor, you would always say, right, okay, so what's happening in your life? What plans have you got? What, you know, where do you want to go with this? And that's where you'd look at, right, is a fixed one the best way to go? Is a variable one? And it's also what your thoughts are about what's going to happen to the interest rates. You might think, actually, I think the interest rates are going to drop, so I don't want to lock into a mortgage at the moment. So you might, right, a variable rate might be good for you for the next year. Others might be like, no, actually, the interest rates are going to rise, so I'd rather stay on a fixed. Or it might be, well, I don't care if they fall or they rise, I just want to know what I'm paying on a monthly basis.
Which for a lot of people, it's worth just having that so that you know what you're doing, isn't it?
Many people go for variable, do they? Because I did, and when I mentioned it to a few people, like, what, you got a variable mortgage? It kind of blew their mind, but I was like the worst possible time when all the rates were really high, and I was pretty confident that they would come down, and maybe not come down as much as I thought they might do, but ultimately, I'm paying less now than I was 2 years ago. But a lot of people, their reaction is really surprised, like they just wouldn't even entertain the idea of variable rates. But that we like certainty, don't we? So the idea of, like, it doesn't really matter what the rate is. Like, if it's £500 a month, I've got to make £500 a month. The rate could be anything, doesn't it? It doesn't matter if there's a financial number for the next 3 years. I've got to pay £500 a month. We can work with that, can't we?
Yeah. That's it. It's looking at what people's budgets are.
Yeah, absolutely.
It doesn't mean to say, and also looking at interest rates might not necessarily be the best thing either, because it depends what the fees are with the lenders as well. So you might look at an interest rate and think, oh, that's a really good interest rate. But then you look at all the fees that you have to pay associated with that. Actually, it doesn't work out that it's the best. So sometimes paying more on a monthly basis in the long run makes it cheaper.
Yeah, absolutely. Is there anything else that we need to know?
Oh, yeah, there's a few things as well. But one of the most important things are your home may be repossessed if you don't continue to pay your mortgage payments. And we have to say that from a regulatory point of view.
Yep.
The other things I would say are, when you're looking at your budget, don't just look at it for the mortgage. You need to account for, if things go wrong, how am I going to continue to pay for this mortgage? You need to be looking at what is classed as protection insurance. So protection insurance is like your life insurance, your critical illness and your income protection. So I would say income protection for self-employed people is essential. Basically what that is, it will give you an income if you are not able to work due to injury or illness. There's various types of income protection policies out there, so that's up to the individual circumstances.
And it's actually, statistically the one that you're most likely to use. And it always surprises me, actually, how high that statistic is, actually. And it is probably the most important, because at the end of the day, yes, if something happens to you and you've got an insurance policy that pays off your mortgage, but that doesn't put food on the table and keep you alive, does it? So, it's about finding that right protection. And you're right, that can add a reasonable amount of money onto your monthly amount of money, can't it?
Yeah, and it's just having that reassurance if something does go wrong, you can actually pay for it. And that's part of a mortgage advisor, a mortgage and protection advisor's job, to discuss that with you as well. And the way I suppose I describe income protection is, that will pay for everything else. So, you know, if you want your pet insurance or your life insurance or whatever it might be, that's fine. But if your income's gone, how are you going to pay for that? Whereas your income protection can help you continue to pay for your mortgage and your lifestyle and everything else that you want to pay for.
Yeah, it's a really good point.
Good thoughts. Final thing then is homework. So we're going to go back to Steve. Steve is a business owner of some sort. This is something that's on his radar. He's thinking, right, got to sort out where I'm going to live. Set some homework. What should he be doing?
He should be checking his credit file.
Okay.
He should be looking at that. And if he can't understand it, go to somebody who can understand it, who can, you know, as mortgage advisors, we read them day in, day out. So if you can't understand it, and you might see things on there, but you might not know what the implications are. So check your credit report. Not just one credit reference agency, all three. So, and
what do you do for that? Do you just go in and like pay like something to have your report sent to you, or is it more like an account where you have to pay so much a month, or is it free? Or
so you can get them for free. The problem with that I find as a mortgage advisor, if you get them for free from one of the 3 different credit reference agencies, they're all in a different order and they're all over the place. And it's like, how do you match up what that credit card's saying from that credit reference agency? Because one might say, oh, you've had a late payment, but another one might not. So it's trying to match all 3 up. I recommend clients go to one which is called Check My File. And that will bring all 3 credit reference agencies into one. Initially, you don't have to pay for it. It's free for 30 days. Then I think it's $14.99 a month after that, but you can actually cancel it within that period as well. So that's where I always ask clients to look at it, and it's just so easy to read.
And what else does Steve need to do? Is that it? Just check his credit file?
He needs to speak to his accountant as well. He needs to get a really good idea as to what he can do within the business. Another thing self-employed people may do as well, which involves the accountant at times, is they may get debts that are for the business, but they get them in the personal name because there's no business history there, so they put it in their personal name. But then on the account side, it's going through the business. But from a lender's point of view, they're checking a credit file and they can see, so say, for example, if Steve bought a van, and that's not for him personally, but it's for the business, but he's got the debt in his own personal name, it's coming out of the business. Sometimes lenders won't class that as a business expense. It's in your personal name, it's your debt. Whereas you can speak to an accountant. Sometimes an accountant's letter will suffice in there saying, actually, it is taken out of the business and we're happy with that. And some lenders will take that into consideration. But planning those business purchases as well as regards personal name or business name is something to work with the accountant.
Yeah, that's a good point, actually.
Yeah.
Cool.
Good stuff. Well, thank you very much. It's been fascinating. Hopefully there's stuff there for people who are in that kind of sweet spot at the moment to kind of take away and hopefully make it a nice, or I'm not going to say nice, smooth journey, but a smoother journey for them. So thank you for joining us and thank you for sharing your insights.
Thank you.
Thank you very much. Thank you.